So with that, let's segue right into our main topic of the day, which is centered around Uniswap, the decentralized exchange, or DEX per its acronym, which uses an automated market-making system to power security token liquidity for Realty and Mount Pelerin. I think it would be great to break down exactly how the liquidity system works, as Uniswap has significantly grown in popularity in both the crypto scene and security token industries, leading to a rise in DEX usage compared to its traditional counterpart. Full disclosure, before we jump into anything though, I do own Uniswap tokens, but none of this is investment advice.
I'm fascinated by this topic and I really can't wait to dive in it. In fact, an article came out last month, that last month in September, Uniswap's total trade volume exceeded that of Coinbase's by over 2 billion to the full tune of some $15 billion in trades powered. So this has to be extremely scary to Coinbase now, as well as the rest of the industry, as DEXs prove themselves to be a formidable alternative to centralized exchanges. So this topic is also a bit of a mystery for many, especially in the security token space, as to all of it works. So hopefully this is helpful to you. And luckily, we've got the CEO of Security Token Market on the show here. He ought to know. So Kyle, can you break down this concept to our listeners, please?
Absolutely. So, as always, I think it's important to begin by clarifying our definitions. Coinbase is a centralized cryptocurrency exchange, and its business model is similar in structure to a licensed ATS or exchange in the traditional markets. Usually, these centralized firms charge a listing fee to each issuer on top of fees on each transaction, while offering custody services in order to provide liquidity to new customers. Centralized exchanges can get away with charging large transaction and listing fees because traditionally there was no other way to get real liquidity for your assets.
Oh, yeah, no. Uniswap, being a DeFi solution, aims to upend this traditional model, and investors are clearly flocking to it, Kyle. So, what does Uniswap do differently as a decentralized exchange?
So Uniswap takes advantage of a blockchain mechanism known as atomic swaps that we've covered in episode 41. Due to the standardization of assets that we see with tokenization, where any real world asset can be easily assigned to a blockchain native asset, you can easily swap these tokens by leveraging smart contracts. Smart contracts act as computer code that can automate the process of exchange that we traditionally only trusted our largest financial institutions to manage in the past. In this way, the trading technology can be iterated upon by companies like AirSwap, EtherDelta, and now most popularly Uniswap to offer trading services that can be trusted and take very little fees when compared to the traditional centralized counterparts. However, the innovation from Uniswap comes from their decentralized solution to liquidity.
Right, and with traditional, established exchanges, market making is a significant competitive advantage, right? And as we've discussed in the past, liquidity is something that you need to build over time. So just because an investor can trade an asset doesn't mean that they will. And as we've seen with many liquid crypto exchanges or even in the security token market, providing just a platform for trading doesn't always prove enough to attract investors to that platform. And many exchanges see very little activity as a result and have a hard time building this ecosystem.
Absolutely. So, to incentivize that market making on its platform, Uniswap created a staking model to distribute fees directly to users who deposited funds within the protocol. Essentially, instead of taking those transaction fees and keeping them for the company, the fees were redirected to the stakers. It was structured so that for each trading pair, a liquidity pool would be created that receives 0.3% of every trade. In this way, an investor that is holding for the long term can take the asset they own, stake it in the protocol, contribute to the market for the very asset they invested in, and earn interest on the asset in the form of transaction fees. Just like in a mining pool, you get the proportion of the fees relative to the size of the pool's staked assets. So if you contribute to 50% of the pool, you'd be entitled to 50% of the profits. Uniswap distributes all the exchange transaction fees to those who staked their assets in the protocol. Uniswap doesn't profit off the transaction in any way, which is a very different model than what we see in the traditional sector, where the transaction fees are the core of the business model.
It's the polar opposite, and we're seeing how popular this new model can be. It incentivizes longer-term holding, and creates buy pressure for the assets on the exchange, and it provides swift order matching by leveraging the immediate settlement of securities on chain using those atomic swaps to remove that counterparty risk. So, the far as I see, the only risk, for liquidity providers, which, they do not have control over the ratio of the two assets you insert into the protocol, right? So when you stake in the protocol, you need to put an equal dollar value for the two assets. So while you'll never really lose the absolute value in dollar terms, you do risk capping your upside if the market value of the asset appreciates while you're stuck with the cash.
So to sum it up, Uniswap's great innovation is in incentivizing liquidity so that any investor can stake their assets, earn interest on their contribution, and power the network so that others can easily buy and sell without encouraging slippage or liquidity crunches. Investors also seem to prefer this model because the fees are consistent and digestible, as Uniswap itself doesn't take any fees for the trade, but also because Uniswap's model is focused around being asset agnostic. Uniswap can list any Ethereum-based token in a matter of hours for free, giving it an edge against centralized exchanges that have an application and listing process resulting in significant friction and a lengthy onboarding process. In 2019, Uniswap became the de facto platform to trade Ethereum-based tokens as they were all immediately eligible. But now we're seeing the true power of automating financial services as these trustless atomic swaps allow for cheaper trades and innovative ways to exchange assets. Regardless of where you stand in the debate between centralization and decentralization in terms of the exchange process, Uniswap has revolutionized the idea of market making and has certainly enabled a much more accessible market making strategy for issuers when compared to the expensive brokers and market makers in the traditional sector.
No doubt about it, the proof is in the pudding. Coinbase may be having a run for their money there. And with that, Kyle, I think we have given our listeners plenty of topics to digest and think about here. And that means it's time to wrap up our show today. So check out stomarket.com/news for any of the links that we covered today on the show. And please reach out to us on Twitter or LinkedIn for any questions or feedback to us. Otherwise, check out our YouTube channel for the clips of each main topic there as, each individual episodes. And of course, tune in next week on Tuesday for episode 65.
Thanks so much for listening. Talk to you next week.